What if I told you there's a pattern in economic history that has been hidden in plain sight? A cycle that predicted every major crash before it happened. It foresaw the 1929 stock market collapse that triggered the Great Depression. It aligned with the 2008 financial crisis that brought Wall Street to its knees. And right now, that very same cycle is pointing directly at 2026. This isn't a hypothesis. It's not a forecast from some hedge fund or the opinion of a financial analyst. It is a 200-year-old economic rhythm known as the Kondratiev Wave. And once you understand it, you will see the next crisis forming before everyone else. Most people have never heard of it. Those who have often dismiss it, because accepting its implications means accepting that nearly everything we believe about economic stability is temporary. If you're watching this video right now, don't click away, because what you'll learn in the next few minutes may completely change how you view money, crisis, and opportunity. Nikolai Kondratiev, a Soviet economist in the 1920s, first discovered that the global economy doesn't move randomly. It rises and falls in long cycles between 50 to 80 years, each divided into 4 distinct seasons: spring, summer, autumn, and winter. Spring is recovery, summer is prosperity, autumn is stagnation, and winter is collapse. According to his analysis, winter is the most destructive phase, marked by debt liquidations, asset deflations, and societal transformation. And here's the terrifying truth. We are deep inside winter. If this cycle holds true, and history suggests it will, then the most probable flashpoint of the next global economic collapse is 2026. And unlike 2008, this time there may be no quick bailout, no easy monetary fix, no soft landing. Let's go through the phases so you can see for yourself. Spring began after World War II, when the global economy was rebuilt from the ashes of destruction. Massive industrial investments, rising wages, and an explosion in consumer spending marked this phase. Summer arrived in the 1960s, a period of widespread prosperity and technological optimism. The space race, economic expansion, cultural revolution, confidence was at its absolute peak. Then came autumn in the 1970s and 80s. This was the era of stagnation, energy crises, high inflation, and growing speculation. Interest rates hit 20%. The economy survived, but only by shifting into aggressive financialization. Winter should have fully arrived in 2008, when the global system nearly collapsed. But governments stepped in. They didn't fix the problem, they delayed it. Zero interest rates, trillions in printed money. Artificial stimulation. They borrowed from the future to save the present. And now, the future has arrived. We are now in the late stages of Kondratiev winter, when the accumulated pressure is no longer containable. According to long-wave theorists, once winter fully manifests, it typically triggers societal restructuring, shifts in global leadership, radical technological adoption, and often conflict. It doesn't simply slow the economy, it rewrites it. The difference is, in past cycles, the world was less interconnected. The crash of 1929 affected America first. Today, what happens on Wall Street ripples across Tokyo, London, Dubai, and Shanghai within seconds. One weak link anywhere can collapse the entire chain. And that's not all. The Kondratiev Wave is only one of 3 powerful cycles converging simultaneously on 2026. First, the debt supercycle, which happens every 70 to 80 years, last peaked around 1930 to 1940, right before the Great Depression. Its next major peak aligns with 2010 to 2020. Second, the generational crisis cycle, which is around 80 to 90 years long, last peaked with the 1929 to 1933 collapse. That aligns its next peak with 2019 to 2023. When multiple cycles align, history shows the crisis is exponentially worse. That is exactly where we are now. So why didn't 2008 complete the collapse? Because central banks intervened like never before. They forced interest rates to zero. They injected trillions into financial markets. They bailed out banks. The crisis wasn't resolved, it was postponed. For a decade and a half, the economy was kept alive via quantitative easing, low rates, and financial manipulation. But here's the catch. You can only fight a winter with an artificial summer for so long. The system is now reaching its breaking point. Now, let's look at the leading indicators that are confirming 2026. Historically, when the yield curve uninverts, a recession follows within 6 to 18 months. It uninverted in September 2024, pointing directly to a crisis timeline of March 2025 to March 2026. Commercial real estate, one of the most debt-exposed sectors, hits a $1.5 trillion refinancing peak in the first half of 2026. Meanwhile, money velocity peaked in 2022, indicating the economic engine is slowing even as prices remain high. Consumer debt crossed the 15% danger threshold in mid-2024, historically followed by a crash within 18 months. Multiple independent signals are converging, pointing to the same outcome. Something will break in late 2025, contagion will spread by spring 2026, and any intervention will arrive too late. According to economic historians, the collapse will likely unfold in 5 phases. Phase 1 is the crack, starting in late 2025 or early 2026. Something significant fails, maybe a major bank, maybe a sovereign debt default. Phase 2 is contagion, which hits in the spring and summer of 2026. The crisis becomes undeniable, markets fall, and public panic begins. Phase 3 is intervention in the summer and fall of 2026. Governments try to stop the bleed. They print money, they loosen regulations, they bail out institutions. But it's too late. Phase 4 is the secondary collapse from late 2026 to 2028. This is where the real damage happens. The system buckles, asset values reset. And finally, Phase 5 is stabilization between 2029 and 2030. A new system emerges. The reset is complete. Those who prepared will prosper. You will not see this on the mainstream news until it's too late. By the time they officially announce a crisis, the opportunity to protect yourself will be long gone. That is why this video matters. If you're watching this in late 2024 or early 2025, you have time. Not much, but enough. Starting now, the informed must reposition. This means reducing equity exposure, building cash reserves, eliminating personal debt, and increasing holdings in crisis-resistant assets like gold and farmland. And most importantly, you have to prepare psychologically, because buying during a panic requires more mental strength than financial skill. This isn't financial advice, it's economic awareness, it's history speaking through data. The Kondratiev Wave has been accurate for 2 centuries. It warned of 1929, it aligned with 2008, and all signs now converge on 2026. You can't stop winter, but you can survive it and even thrive in its aftermath. Before we continue, smash that subscribe button, turn on notifications, and tell me in the comments, what do you think will trigger the 2026 crash? Is it debt, geopolitics, AI disruption, energy wars, or will it be something none of us expect? Because time is short. If history has taught us anything, it's that fortunes aren't made in times of prosperity. They are made in times of panic. When markets are calm and everyone's feeling good, it's easy to invest. But when fear takes over, only those who are truly prepared make a move. The 2026 economic crisis, which many are predicting based on things like the Kondratiev Wave, the debt supercycle, and a generational reset, isn't just going to be a period of financial pain, it's going to be the biggest wealth transfer window of our lifetime. In every winter phase of economic history, the people who understood what was coming didn't just survive, they emerged as the next generation of financial elites. Think about it. The Great Depression gave birth to some of the largest fortunes in modern America. The 2008 crisis created more billionaires than any previous downturn. Even the crash of 1873 paved the way for the rise of the railroad tycoons. It's always been the same cycle: winter, destruction, opportunity, and then a reset. So let's stop just diagnosing the problem and start talking about a positioning strategy. The key to not just surviving but thriving in 2026 is understanding that a collapse isn't the end. It's the beginning of a new cycle. Right now, most people still believe the system will recover. They think inflation will stabilize, that rate cuts will fix the economy, and that incredible AI innovation will save us all. But that's exactly what people believed in 1928, in 2007, and in every autumn phase right before the fall. Winter doesn't care about our beliefs, it enforces reality. During an economic winter, the system brutally corrects the imbalances that have built up over decades. Artificial wealth gets destroyed. Overvalued assets get repriced to their true worth. Capital floods back into safe, liquid assets. Debt gets wiped out. And the global economy resets itself to a level based on fundamentals, not on wild speculation. What separates those who collapse from those who rise during these events is a simple three-phase personal strategy: withdrawal, positioning, and re-entry. Phase 1 is withdrawal. This is happening right now and will likely continue until late 2025. This is where the smart money is moving before the first major crack appears. We're already seeing institutional investors reducing their exposure. Family offices are dialing back their risk. Sovereign wealth funds have started positioning into hard assets. You need to do the same. Cut your leverage. Get out of overvalued tech and speculative stocks. Avoid real estate that depends heavily on debt. Reduce your dependence on market cycles. The goal here is to build liquidity. Cash isn't safe forever, but it is absolute power during a panic. Phase 2 is positioning. This will likely start in late 2025 and go into early 2026. This is the phase where the crack appears. When something major breaks, a huge bank failure, a country defaulting on its debt, a liquidity freeze, panic will spread like wildfire. At this point, conventional advice will tell you to do nothing, wait for stability. But that's not how wealth is made in winter. The greatest returns in history come from buying when everyone else is frantically selling. Not blindly, but with surgical precision. You need to look for crisis-resistant assets, things like gold, energy infrastructure, agricultural land, defensive sectors, and companies with a high cash-to-debt ratio. When markets crash, liquidity is king. When the lights go out in a panic, the person holding the flashlight gets to buy the whole room for pennies on the dollar. Phase 3 is re-entry. This is the era of acquisition, probably from 2027 to 2030. It starts after the initial shock when governments and central banks intervene and a secondary collapse begins. In past cycles, this was when investors like Warren Buffett made their largest and most legendary investments. It's when John D. Rockefeller bought up assets at 90% discounts during a crisis. It's when the Rothschilds financed entire operations in a collapsing Europe and positioned themselves as the new economic stabilizers. When central banks eventually reintroduced liquidity to reboot the system, those who have capital can buy the future at liquidation prices. Now you might be asking, what if this cycle theory is wrong? What if the crash doesn't happen? Let's be clear, preparing for a crisis doesn't mean you should panic. It means strategic adaptation. If the crash doesn't arrive as predicted, being positioned with strong liquidity, low debt, and hard assets still places you in a much stronger long-term position than almost everyone else. History shows us that major collapses often follow periods of widespread denial. In 1929, newspapers insisted the market would recover just 2 days before the big crash. In 2008, the U.S. Treasury Secretary declared that the economy is fundamentally sound, only weeks before Lehman Brothers collapsed. Today, what do we hear? Major figures insist the landing will be soft, that inflation is under control, and that markets will rebound any day now. The cycle suggests otherwise. Let's look at a few historical case studies to understand the psychology of wealth during a collapse. During the Great Depression, while millions lost everything, a tiny fraction, less than 1%, bought up bankrupt assets and land at record lows. Their acquisitions formed the foundation of America's industrial dominance for the next half-century. During the oil shock and rates crisis of the 70s and 80s, savvy investors positioned into commodities, energy, and gold as inflation ravaged economies. Gold rose over 2,000% during that winter phase, and in the 2008 crisis, while most people fled in terror, hedge funds like Paulson and Coase made $15 billion by betting against the housing market. Warren Buffett invested in Goldman Sachs and GE at the absolute peak of panic, and both deals generated massive returns. Today, the average household carries record consumer debt, has zero emergency savings, and is fully exposed to the stock market. This is the exact opposite of a crisis-ready position. Meanwhile, the wealthiest institutions are quietly building up their cash reserves. Something is forming beneath the surface, and those who study these cycles know what's coming. So, what should you do? For Phase 1, reduce your exposure. If you're 90% in equities, consider moving to 40 or 50%. Exit highly leveraged assets. Cut your unnecessary expenses. Pay off consumer debt, even if it seems manageable right now. For Phase 2, build and hold liquidity. Accumulate cash or short-term bonds. Protect your buying power, and wait for the structural weakness to show itself. For Phase 3, be ready to convert that liquidity into crisis assets. This means gold, silver, energy, and agricultural commodities. It could be farmland or water rights. It could be businesses in essential sectors like food, power, and logistics. And once the deep correction arrives, you buy great companies at a deep discount. But the most important asset you can have, mental readiness. Because when that crack forms in 2026, headlines will be screaming, "This time is different." Panic will flood the markets. Fear will override all logic. The best opportunities will appear at the exact moment when it feels most dangerous to act. Remember, winter is the most violent phase of the cycle, but it's also the one that births the next spring. And historically, spring begins about 3 to 5 years after the initial collapse. This means if the crack begins in late 2025 or 2026, the real period of growth might start around 2028 to 2030. By then, the average investor will finally feel safe enough to try and re-enter the market. But it will be too late. The cycle rewards those who understand and prepare for winter, not those who return after it ends. So now it's time to ask yourself, will you be the one who just watches history repeat itself? Or will you be the one who uses history to break free from the cycle? Because the Kondratiev Wave isn't just predicting a collapse, it's offering a roadmap. Winter is coming for everyone, but those who prepare now will emerge in the new spring as the leaders of the new financial world. If this opened your eyes, hit that subscribe button. Drop a comment below and let me know. I'm preparing for 2026. Or tell me what phase you believe we're currently in. The cycle has spoken. Now the question is, will you listen? Thanks for watching.